Hello, and welcome to Your Money 2.0. I'm Thomas Fox, Community Outreach Director of Cambridge Credit Counseling. As you know, millions of Americans are facing foreclosure, and for a variety of economic reasons. Some homeowners purchased homes that were simply beyond their means, while others fell behind in their mortgage payments after losing their jobs. As the housing crisis continues, there's another factor that's driving people from their homes. Some people have the money to pay their mortgage, but are simply walking away because they believe it's best for their financial situation. This action is referred to as strategic default, and it can have a long-lasting, harmful effect on your financial future. Negative equity, often referred to in the media as being underwater or upside down on a mortgage, occurs when a borrower owes more than their home's current value. Home prices across the country have decreased an average of 30% from their market highs in 2006. For example, a home purchased for $230,000 4 years ago may actually have lost $69,000 in value by today. Mind you, this is just an average. Some areas of the country have seen property values decrease by almost 60%. The research firm First American CoreLogic recently reported that 11.3 million residential properties were upside down in their mortgages at the end of the fourth quarter of 2009, and an additional 2.3 million mortgages may be in similar danger as 2010 begins. That's slightly more than 1 out of every 4 American homes. Rather than continuing to make payments on an investment worth significantly less, many homeowners are simply walking away from their homes. Defaulting on a loan that's lost 60% of its value may seem like a savvy financial move, but there can be significant financial consequences that many borrowers may not even be considering. Across the country, collection agencies are poised to collect on the mortgage deficiencies that can result when a homeowner stops making payments. Many lenders looking to recover their losses are selling deficiency judgments to collection agencies. These agencies may choose to wait 2 or 3 years until the defaulted borrower has recovered financially. Once their circumstances have stabilized, the collection calls will start, and what seemed like a short-term fix could instead become a long-term nightmare. Many homeowners are under the misconception that once they walk away from their home, their mortgage debt is forgiven. But this is not always the case. Depending upon the state where they live and other factors, homeowners who lose their home to foreclosure, sell the home through a short sale, or return the home to the lender through a deed in lieu of foreclosure can find that their loan remains valid unless the mortgage holder agrees to forgive the debt or applicable state laws prohibit the collection of deficiencies. The borrower can remain obligated to pay the lender all principal, interest, and fees, regardless of what happens to the home. Generally, any money received at the foreclosure auction or sale will be deducted from the total amount due to be paid to the lender. The difference between the total amount owed and the amount recovered at the foreclosure auction is called the deficiency amount. For instance, if your mortgage was $230,000 and the lender received $161,000 for the property, you may be responsible for the difference of $69,000. As the mortgage crisis widens, many lenders will undoubtedly decide to pursue the money owed to them by seeking deficiency judgments, which are enforceable by courts in more than 40 states and can be exercised for 12 years and beyond if the lender renews the judgment. Therefore, this is not a situation to be entered into lightly and without professional and legal guidance. Before you make the decision to walk away from your home, participate in a short sale, or surrender your deed in lieu of foreclosure, I urge you to contact an attorney and a HUD-certified housing counseling agency. Counselors are well versed in the options best suited to help you manage your mortgage obligation and will work with you and your lender to come to a decision that is equitable for all parties. The alternatives are costly, as you've heard, and the phone call could help you avoid tens, if not hundreds of thousands of dollars in deficiencies. Well, that's it for this edition. As always, we welcome your feedback and ask for your thoughts and suggestions by emailing us at yourmoney2@cambridgecredit.org. Thank you for watching. Until next time, I'm Thomas Fox for Cambridge Credit Counseling.